Can we talk about the entire idea of centrally planning the interest rate as just another form of price fixing? Like, so you said you advocate for decentralization. So would you advocate then for free market interest rate price discovery as well?
I think the truth is, it's perhaps not very popular to say this, but the truth is we don't need central banks.
Yeah.
The central banks came about originally in every country as a cartel of the big banks. Mm-hmm. And if that cartel had been used, and sometimes it is used, rarely, but sometimes it is used for the common good, mm-hmm. then actually, you can make it work. But it's really still not needed. It has the advantage for the banks that there's always an institution to bail them out. But if you set the right policies and the right incentives in the first place, you won't get into a situation where you need a bailout, right? Mm-hmm. And that's surely more desirable. But it's a fact that credit guidance compared to any other intervention is still highly effective mm-hmm. and achieves the result. But who should do it, and should it be in secret? And that's my main criticism. They do it in secret because they don't want this power that they have, and they have used. And they have used actually for many bad things, like to create a recession on purpose, to prolong a recession, or to crush a banking system, to cause concentration of the banking system, to create an asset bubble, to redistribute wealth from the many to the few. They've done all that, but in secrecy. Yeah. Whereas if you make it open, transparent, they can't get away with this stuff. Yeah. And that's why it's always being kept secret.
Isn't that a slippery slope too? And I mean, I hear you that of all the intervention techniques, this is probably the most effective because you're intervening with the most important price in the world.
Exactly.
Right. So that makes sense. You get a lot of leverage on a small
in many ways, it's part of managing the public good that is money.
That's what I want to ask about. So this idea of the common, like a public good, okay, money is a public good, a common good, basically. Yeah. But this idea of manipulating money for the greater good or for the common good, that's like a sort of a different perspective on that. It can be this ephemeral thing, that demagogues can attach to and say justify any action, basically.
Right, exactly. So that's the slippery slope. But if it's done in a simple way and in a very restrictive, very focused way mm-hmm. and fully transparently, mm-hmm. then it'll work, because then you're not doing these secret shenanigans they've been doing. Yeah. And so in other words, it should be very simple rules, such as the following. Because banks are money creators, which is a public function. So mm-hmm. we've got private sector entities that are engaged in doing something that affects the whole public. Mm-hmm. Who gets the new money? For what purpose? How much? Will reshape the economic landscape, mm-hmm. And that's very powerful. That affects us all. So if there's only big banks and they lend to these big private equity funds and hedge funds, you get a very different outcome from when you have an economy with thousands of small local community banks lending mm-hmm. to small firms, which are the job creators, mm-hmm. and they let the small firms do their commercial capitalist business without further intervention. You will get high growth without asset inflation, mm-hmm. without consumer price inflation, mm-hmm. and without crises. And that's something where the central banks the government could show. We don't need central banks for that. Government could look after this. Yeah. For example, by having a law which says, you could scrap all bank regulation, only have this rule: banks are only allowed to create credit for transactions that contribute to national income. Sounds fair enough. And most people, when they hear this, will say, well, aren't they doing that? No, look at the UK. All right. 85% of bank credit is for asset purchases, which doesn't contribute to national income. Right. It contributes to the rip-off of the public and wealth redistribution and asset bubbles and banking crisis. And that's why we had the repeated banking crisis in the UK. Right.
So restrict lending to only productive commercial activities. Is that right? Not just the transfer
for business
assets.
Investment. Yeah. In other words, not for asset purchases.
Right.
Consumer loans, strictly speaking, you could also ban bank credit for consumer loans. And this would also mean you get no bank credit for buying a house, mm-hmm. An apartment, mm-hmm. real estate, land from banks. Mm-hmm. But I'm not saying, hey, let's ban these transactions. That's ridiculous. And actually, in practice, will be very hard and won't work. So we shouldn't ban speculation, mm-hmm. which, it's hard to do, but we shouldn't even try. But let the speculators that do the financial asset transactions, let them raise their money, in the markets from non-banks. They can get it from non-banks. Okay, what about families? There's a young family. They want to have children. They need some space. They need a house. They need some, they need to move out from the apartment from the small apartment to somewhere bigger. They need a mortgage. Well, let's create non-bank mortgage lenders. So they're not banks. And let's have many of them. They have to compete fiercely to offer really competitive mortgages to them. And the banks are not allowed to get into this business. Problem solved. Well, hang on. Isn't this the same thing? No, because if they're not a bank, they can't create money. Well, how are they funded? Well, they can fund themselves through issuing bonds from these efficient capital markets we always hear about. No problem.
What about sound money? Like, what is the role of sound money in rectifying a lot of these problems that we're just, again, looking to the centralized institution to try and reform itself or, change its regulatory orientation to the market. Whereas if we just adhered to sound money, because as you said the other day, that this progression into fractional reserve and ultimately zero reserve banking was originally a violation of contract law, for instance. Like, had we just upheld private property rights and contract law, we would have never gotten into this mess in the first place. So isn't sound money just a return to those basic principles?
Yes. And of course, in a modern system, what does it mean? It does mean that money creation is linked to somebody making a contribution to the economy, which is the original capitalist idea. The capitalist entrepreneur should be funded with money creation. They're the ones that deserve, to be funded with money creation. But if you do something that's not actually contributing, it's just speculation, changing ownership, well, that should not be backed with money creation. So sound money means linking the money creation, the credit creation, to the creation of goods and services, introducing new technologies, increasing productivity, having a good idea that adds value, that should be backed, but not other things. Because you will find then you can have high growth and no inflation. So in other words, my take on sound money is not what some people recommend. Oh, there shouldn't be any money creation at all, because otherwise we get inflation. Well, the fact is you will get little economic growth. You're not encouraging growth, and you are actually constantly under deflationary pressure in that case. So, and that creates problems that we don't really need. So there is something magic about banks. We can use it for the good. The redeeming feature of banking is if and when you have many, many small banks that are locally accountable and they're almost entirely funding entrepreneurs, so small businesses getting loans from them. Because that's hard work to evaluate each loan application. And if the amount is small, you've got a lot of hard work and you don't get that much absolute pay out of it. But that's the real job.
The credit assessment, the maturity matching, you're funding investment from real savings, and the banks, if they fail in that function, then they fail, right? You said locally accountable, or they have skin in the game.
And they're small, so they're not going to be bailed out.
Yeah, and that seems to be the key, is the distribution of risk, right? Like if it's actually the risk is distributed to the individual banks such that the actions they take, they are married to the consequences, right?
Yeah,
whether reward or penalty.
Now, that switch was actually done very dramatically in China, and it explains this incredible economic growth we experienced in China, where for 40 years, 4 decades, we've had double-digit growth, close to 15%. Therefore, doubling national income every 4.5 years, again and again. That's how China developed so rapidly that essentially it's close to being number one economy in the world. And they did this because they switched from the Soviet system with one central bank and one bank. There was only one bank. To the decentralized system. They looked at Japan. They studied Japan. They asked the Japanese, how did you do this double-digit growth for 2 decades? And the Japanese told them, well, you need banks. And so Deng Xiaoping came to power in 1978, went to Japan, asked them, tell me the secret of high growth. And he came back and he founded banks, thousands of banks, small banks, local banks, village banks, savings banks, regional banks, provincial banks, rural credit unions. And the rest is history. lending to small firms. You know, the comparison is, on the one hand, you could have a centralized system where maybe, so you've got one central bank, one bank in the whole system, Soviet style. Then you maybe have a committee of 5 people deciding how much money to create and who to give it to in the entire economy.
Right. It's like the Soviet pricing czars.
Which can't be effective.
Right.
And that's what Deng Xiaoping realized. What the Japanese told him. You've got one bank for, and China at the time maybe was 600 million people already. Well, how about you have 5,000 banks? And then if you have 5,000 banks with, let's say there's 30 branches each, okay? And then you have maybe 35 loan officers in each branch dealing with small firms. Then you have more than 5 million loan officers doing this analysis.
Right.
And of course, they will look at per year at dozens of applications. So you're dealing with hundreds of millions of loan applications by small firms. Right. The best are selected, which are viable, make sense. They kick the tires, they go around, they check out these companies.
This is a compute problem. Distributed computing is superior to centralized
distributed because it's decentralized and it works. Which system is better is the question, and Deng Xiaoping was faced with that. 5 guys at the central bank deciding the creation allocation of the entire money supply, or 5 million loan officers on the ground in every village checking all these hundreds of millions of loan applications. Well, I think it's pretty obvious which system is going to be better.
Absolutely.
And Deng Xiaoping did the right decision.
So this is such an interesting point.
And then 5,000 banks were created, and the rest is history.
Thanks for watching. If you enjoyed this episode, click here to find more just like it, and here to find our most recent episode. Also, make sure to like this video to help shine light on the corruption of money, and be sure to subscribe to this channel to stay connected.